Welcome to Navigation Trading Live. You are now part of a growing group of do-it-yourself traders who are trying to change the way investors think about building wealth. But because we don't believe in using financial advisors, stock tips, or traditional financial media, we have to do things different. We have to do things smarter. We do that through an art and a science we call trade hacking. At Navigation Trading, our methodology is based on statistics and probabilities, not hype or emotion. Our core strategies have been used by market makers, hedge funds, and floor traders for many years. Now, we share these secrets with you. Whether your goal is to make an extra $1,000 per month or replace your current income, with our guidance, you can achieve financial success beyond your wildest dreams. So, let's get started. Good morning. Hope everybody had a great weekend. Gonna go ahead and get started. Hope you like the new little intro. So this is Navigation Trading Live, and we are going to jump into the trade of the week. But first, I wanted to recap our last week's trivia contest. So the contest question had to do with put skew. What is put skew and when did it start? And congrats to our winner. I'm not going to attempt to pronounce his name. I think this is a username anyway, but congrats. He won the Trading Calendars for Income course. And the answer to the question was put skew is the fact that puts are more expensive than calls. And that started after the 1987 crash, and they realized that puts, when the market goes down, the market accelerates to the downside quicker than it goes up. So you've probably heard the term as a trader, the market stair steps up but takes the elevator down. Well, that's what's created put skew. So congrats on that. And let's go to this week's trivia contest question. And remember, to be eligible to win, you have to A, answer the question correctly, but B, you have to post your answers in the comments section of either Facebook or YouTube. And so the first listener to answer correctly wins. Please don't email. Those answers will not be accepted. They have to be posted on YouTube or Facebook. So let's take a look at this week's trivia question. So according to Navigation Trading's Iron Condor methodology, we like to collect a minimum amount of credit in relation to the risk we take. So the question is, what is that minimum percent of credit relative to the risk on the trade? Okay? So what is the minimum percent of credit received relative to the amount of risk that we take on a trade for Iron Condors? There's a minimum amount. There's a minimum percentage that we like to collect. What is that percentage? So post your answers on Facebook and YouTube, and I will follow up and be checking that throughout the week. And you win a free course from Navigation Trading, so the course of your choice. So good luck to everybody, and we'll be recapping this next week as well. So couple announcements, same kind of thing I've been talking about the last few weeks. A new course is coming out, and that's going to be released next week. So excited about that one. Put a lot of work into that. I think you guys are really going to like it. And then our strategy book is coming out next month. We're in the process of kind of moving things around as far as for our platform. So we're waiting for that to finalize and the final stages of editing for our strategy book, but that'll be coming out. Really excited about that. And then, of course, the new lower commission rates. And I know I've been getting a lot of emails about this, and we are pushing as quickly as we can. It's really not in our control as far as how quickly this gets done, but I promise as soon as it does, we are as frustrated and as excited to get this done for you as you are to get it for your account. So we'll be letting you know as soon as we can on that. And then remember, if you guys have any topics or questions or suggestions that you want us to discuss on the broadcast here, make sure you send us an email or post it here on Facebook and YouTube, and we'll do our best to try to get to those topics. No new topic of the week. Last week we talked about rolling strangles early, so I just wanted to reiterate that. We're based on our experience trading and a lot of the back-tested studies that we've been doing and seeing lately. We want to be rolling our strangles early. That's part of, remember with strangles, you have naked options. And so one of your main ways to defend those positions and minimize risk is not to let that gamma get too high. And the gamma gets the highest in the last couple weeks of trading leading up to expiration. So we really want to roll those strangles, and we're going with our alert subscribers. We're going to start rolling or closing them with around 21 days to expiration. So continue to do that, and you'll kind of continue to see us, always trying to get better, always trying to find a little bit more edge in our trading. We want to be as mechanical as possible and consistent as possible. But when we find something that really can enhance our trade returns and minimize our risk, we're definitely going to be open to that. So, all right, let's jump onto the platform and take a look at what's going on here in the markets. Looks like the S&Ps are up about 5 1/4, Dow's up 61, Nasdaq's down a few. So kind of a mixed market, fairly flat. IWM or the Russell is up almost 0.5%. So that's the strongest of the indices. Bonds down a little bit. The VIX index is up, but the VIX futures are down about 0.5%. Oil making a big move, up over 3% already this morning. If we take a look at, and that's, it's interesting. It's not really moving the implied volatility indicator. I've had this huge move down and then big swing back up, and it stayed pretty flat here for the last week and a half, which is surprising. I would have kind of assumed it would have crept up a little bit more, but it is what it is. We do have a position on in oil. Gold up about 0.5%, and implied volatility just continues to stay extremely low in gold. Silver's been moving. Had that huge move down. That's popping back up. Implied volatility is still fairly low there, though. Natural gas making a decent move, down a little over 2%. If we take a look at the implied volatility using UNG, the ETF, it's at about 12. Soybeans up a little bit. Corn down, wheat down about 1.5%. May need to make an adjustment in wheat this week if it keeps going down on one of our positions. EWW, the Mexican ETF, pretty range bound, low IV. FXI, the China large cap, it's popping up in the last week. Implied volatility is still fairly low. We look at the euro, getting a little bit of a pop in the euro. And FXE is the Euro ETF. Implied volatility up around 29. Not quite as high as we want to sell any more premium in there, but EEM is the emerging markets. EFA is the international index. EWZ. EWZ, implied volatility is getting close to where we like to see it, and it's starting to make a little bit of a move up in price. Apple, we put on a position last week, and it continues to move higher, but implied volatility is in a nice, decent range there. Facebook, starting to go a little bit range bound here. Implied volatility a little under that 50 level. Netflix down about 0.5%. Google pretty flat. Tesla down a little over 3%, making a decent move down there. Costco pretty flat. Amazon down. Starbucks up a little bit. Let's see if Snapchat up 2%, so it's kind of coming back a little bit after their earnings announcement. XOP, which is an oil and gas ETF, we've got a position on in there, and it's one of the lone rangers with IV over 50. And that's about a J&J up almost 2%. That's about it for the big mover. So what I'm going to do is I'm going to look at, because we have low IV across the board in most things, and we've already got positions on in the underlyings that have some decent IV, one of my go-tos at that point is the grains. So we actually have a position already in corn and wheat, so I'm going to put on an iron condor in soybeans. So we've got a nice pop today in price a little bit, so let's take a look at the option chains. We've got one that's 39 days to expiration, which would be our preference. So we go to the call side, we go to the 20 delta, we're going to sell iron condor. And I like to go 10 points wide initially on here. And then we'll look at go a little bit tighter on the call side. We can either go 17 or 24. I always opt for the higher delta. So we'll look at the 940 on the put side. And then we do our 10-point wide wings, so that'd be 930. Let's analyze this, make sure that lines up the way we want it. And so what I like to do is I like to analyze this, and then I can decide if I want to go a little bit wider. So I'm going to actually widen these wings out to 20 points. And that's going to increase our probability of profit a little bit. And increase, obviously, what it takes to put on the trade. So about 718, 725. Max profit is 275. Okay, so that's a good risk reward. We can set our slices to break even to the June 24th. Got about 60% probability of profit. Max profit about 281. So that looks good. I'm going to get off here and I'm going to go ahead and send that and then shoot that out to our alerts members. Remember, if you're interested in being an alerts member and you're not already, make sure you sign up. We've still got the $7 2-week trial, and I think you will enjoy it. So, done really well all year in our alerts. So, come on board. Let us know if you have any questions. Have a great week of trading, and we will talk to you soon.